Slowly got a few coming in, quite a few note takers. We'll kick off in about a minute. I'm going to shut down all my notifications. Welcome, lots of familiar faces, a few new ones. Thanks for joining us today. Okay, I'm going to get started. Hello, Tractor and Black Nova portfolios. Olivia Doherty here. I look after the Tractor community, Tractor partners, and additional capital for existing portfolio. Welcome to our Exit Ready Masterclass, How to Build, Value, and Sell Your Business for Maximum Profit, brought to you by the team at Flippa. First and foremost, in the spirit of reconciliation, Tractor Ventures and Black Nova Venture Capital acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today. We've been looking forward to this one. Sure to be a great session. There'll be over 50 of us here, I am sure. Today's Blake, do you want to jump to the next slide, please? Thank you. Well, yeah, there we go. Today's masterclass will be run by Blake Hutchison. Blake is CEO of Flippa, the largest global platform to buy and sell online businesses. He has led growth and commercial teams at some of the world's fastest growing companies, including Zero, Luxury Escapes, and Lonely Planet, and regularly speaks on leadership, sales, growth, marketplaces, and M&A. Next slide, please, Blake. Before I hand over to Blake, allow me to run through some housekeeping. Love you to set your name to your full name and company, example of mine there on the deck. This event is being recorded and will be circulated after the event. Please keep yourself on mute if you're not speaking. We do love video, keeps the session a bit more personable. So if you don't mind, leave your video on. Apology for the dog in the background. And the last part of the session will be reserved for Q&A. You can ask questions either in the chat throughout if it's burning, or use the hands up function, or you can leave it to the end, about 20 minutes of Q&A. With that, I will hand over to Blake. Blake, over to you.
Thank you, Olivia. I appreciate that. Thank you so much for putting this together, and really nice to meet you all. As Olivia mentioned, my name is Blake Hutchison. I'm the CEO here at Flippa. We are a global platform, although headquartered here in Melbourne, Australia. And for 15 years, have been building out our platform to support business owners from all over the world. But I'm here today to talk to you all a little bit more about getting exit ready, how the process goes from end to end, and hopefully give you some, I guess, pointers on how you might think about an exit, be that today or be that in the distant future. For context, we do represent business owners from all over the world. We complete just in excess of 11,000 exits across all values each year. And we have a very large buyer and investor universe of in excess of 1.4 million buyers, from individual acquirers all the way to strategics and institutionals. I'll keep the selling of Flippa to a bare minimum and hopefully provide you with a bunch of insight. I do love questions. They're actually really helpful because I can understand where you would like me to go. So if you do have any, yell out at any time, or as Olivia said, just use the chat function. And if I happen to miss a question in there, Olivia, just yell out and I'll make sure that I get to that. So kicking right in, the first thing that we like to talk about here at Flippa is this concept of getting ready early. And so the exit journey is quite complex. It's relatively long. Most people think it's going to be quicker than they anticipate. And so it's important that we start off with a very rudimentary view of the journey to an exit. And so first and foremost, we'll talk a little bit about deciding to exit and the decision-making criteria that most people go through. We'll talk a bit about building a business with an exit in mind. And for most out there, it's actually very similar to building a business with an investor in mind, be that venture capital, high net worth, family office, or private. albeit a little bit nuanced. We'll talk about the buyers and who they are and the differences between them and therefore what they look for. We'll talk about valuation and we'll give you some real life examples of that. And then finally, I'll make some closing comments just on the due diligence and the deal closing process. So we're going to try to cover a lot through the session. And that's probably a good place to just mention my direct email in the event that you want to ask any questions post chat as well. So you can get me at Blake, BLAKE, at flippa.com in the event that you have questions about, excuse me, things I've covered today, but haven't gone into enough detail on. All right, so first and foremost, deciding when to exit. So most successful exits start with early planning. This has become very obvious to us here at Flippa. It's less likely that you get a successful exit having decided today and not necessarily having thought about it prior to that and not necessarily putting in place the requisite processes, plans, and financial maturity that you might need to exit. And so ideally, you want to start to plot your pathway to exit 12 to 24 months prior to sale. And so what that means is looking ahead and thinking about what a good exit scenario sounds like for you, and then trying to understand exactly what buyers will be looking for so that you can reverse engineer that exit scenario. So generally speaking, the way we think about it is that owners and founders should spend at least 3 to 12 months optimizing their business performance, essentially taking those weaknesses and turning them into strengths over a 3 to 12 month period of time. Once that has occurred and yourself and your advisor, be that Flippa or anyone else for that matter, have agreed that your business has been optimized to a level that makes sense for the market, then of course it comes down to preparing your financials and the documentation, most commonly referred to as an information memorandum. That process is actually quite time consuming because it's very much about storytelling. It's very much about not only getting the documentation in order, but then figuring out a pathway to telling the story that is going to most likely resonate with your preferred buyer. And of course, we'll talk about those buyers in a minute, but the way a strategic buyer looks at your asset, your business, versus the way an institutional buyer might look at your asset or business is quite different. The process then will typically require buyer matching. And so in many cases, a broker or an M&A advisor will literally use the equivalent of a Rolodex, which of course is their iPhone or a CRM. Here at Flippa, we do 425,000 programmatic AI matches each week, over 20 million annually. So we have an sort of unfair advantage in finding buyers for particular business owners and those looking for an exit. But regardless, everyone will then pursue this pathway of discovery, figuring out a fit between your business and the preferred buyer. And then, of course, providing that preferred buyer with as much information as possible and trying to establish whether they are acquisition ready and you are exit fit. That feedback loop is almost always on. And in our case, we will have weekly touch points with our clients just to make sure they understand all of the buyers that have been matched, the discussions that are being had, and give you an always on feedback loop to understand how the deal is going and the process and progress that we are, of course, making on your behalf. And that's a really important part because sometimes those people who are pursuing an exit forget that they're a critical part of that process as well. And they either fall asleep at the wheel and not necessarily run their business to the optimum, or they're not as involved in the exit process as possible, and they limit the chances of a deal getting done in the way that we would hope. Of course, these are much like finding an investor for your business. It is very much a marriage. So it's about not only whether the investor will give you fair market value, but it's also about whether that investor is going to be a good fit for you and your business long term, noting that in most cases, you are talking about some kind of earnout and or stability payment, which ensures that you stay with the business for a short and or in some cases longer periods of time. So a very important piece being that feedback loop. And then finally, we get asked this a lot, but the average due diligence process is between 30 and 90 days. And so that will essentially dictate whether a deal gets done. So start to think about the exit process 12 to 24 months out, and then recognize that you're talking about a almost 6-month process from the time you go to market to the time you ultimately find that pathway to exit. So very important that the exit journey is understood and respected, because it is time consuming and often a little bit exhausting. So I want to give you a couple of examples here of 2 businesses. One that chose to sell and it was exit ready, had put in place that level of preparation, and one which had to sell because they essentially had gotten to that point where they decided that they needed to get a deal done in a very short period of time. And the differences are quite stark in both the emotions involved in the process, as well as the deal and how the deal ended up going. So I'm just going to fast forward through this a little bit and give you that context there. Just going to minimize the attendees for a minute there. So I've got 2 examples here. I've got one on the left-hand side where the owner and founder was able to essentially choose to sell, while the owner and founder on the right-hand side had to sell. Now, in one case, it was a bootstrapped founder. In the other case, it was a venture-backed founder. The first was a day trading ed tech business, so educational technology. And you can see there that in one case, one was a marketplace on the right-hand side. On the left-hand side, this day trading ed tech business that I'm alluding to was a SaaS business. 60% of their revenue was SaaS driven. The remainder was advertising driven. They were a relatively small business, so sub 10 million, which is where we specialize here at Flippa. So it tends to be the context from which I am talking. And you can see here that in this particular case, the trailing 12-month total turnover, or as identified here as revenue, was just in excess of $3.5 million. And it was a predominantly US-orientated business, US customer base. Now, there's a couple of things about this business. The business was bootstrapped, and so that pressure of growing extraordinarily quickly wasn't there for this particular founder, and they were able to eke out 25% year-on-year growth for some period of time. If I remember correctly, it was around a 3 to 5 year consistent performance of 25% year-on-year growth. Now, in this particular case, the owner was looking to retire. So they were happy to keep working, but opportunistically, they recognized it was a good time to exit. The business had done well, and there were enough buyers in the marketplace that could give them what they wanted. Now, in our particular case, we are rich with buyers, so we have the ability to match up to quite a number of buyers at scale. And you can see there that in this particular case, it was just short of 6,000 buyers that were matched up. We had over 168 people demonstrate some level of interest, and it was ultimately acquired by a financial news publisher for just over 4.5 times revenue. Now, the interesting thing about that process was due to the fact that it was bootstrapped, due to the fact that it was consistently growing, due to the fact that the owner, whilst looking to retire, was quite flexible in the approach they took to the exit. It was a relatively easy pathway for both this founder as well as the advisory team here at Flippa in going through these buyers and essentially triaging them and finding the perfect buyer. Now, the speed at which we had to act and the sort of emotional heartache that we dealt with in the case of the right-hand side case study was entirely different. So this was a venture-backed Australian-based influencer marketplace. Clearly, they were targeting unicorn growth, aren't we all? In this particular case, they had grown but the ultimate outcome for them, at least for the trailing 12-month performance, was 3.5 million GMV, so gross merchandise value. Of course, marketplace is being assessed a little bit differently to SaaS businesses, and they had quite a high take rate. So relatively good ability to derive revenue from their GMV performance. And you can see that they're represented in the form of $1.2 million trailing 12. They had a lot of talent on the marketplace. So it was a talent matching marketplace, matching brands with influencers, and they had over 14,000 community members as a part of the marketplace. Some good things going for it, but they had to sell. They had to sell because it was venture funded. The VCs weren't going to give them any more money, and the growth rate didn't justify what that business had set out to achieve in the first place. In addition to that, the founder was tired. And so this is a tricky situation where the business owner had essentially decided to wave the white flag, i.e. surrender. I can't do it anymore. I'm tired. I loved this business. I no longer do. I want to move on to greener pastures, and I'm looking for a safe landing. So that creates a lot more stress and a lot more pressure for everyone. Regardless, we were able to obviously find a large number of buyers interested in it. We don't dismiss the fact that we were dealing with a quality asset, but it was acquired a bit quicker than the asset on the left-hand side. And we were a bit limited in the discussions we could have with our buyers, given the speed at which we had to operate. And you can see there that it was still a pretty good outcome. I do obviously have the net profit multiples on these case studies as well, which I can give you over email, but you can see there that it was acquired by a high net worth for just short of 3 times revenue. And so this is really just the difference between preparing for an exit 12 to 24 months out and really getting desperate around the process that you want an advisor or someone like a Flippa to undertake. So context around the difference between preparing versus having to sell.
I could just jump in if you don't mind. There's a couple of questions in the chat. Great slide. James has asked what years these exits were. Also interested to know rough gross margin and EBITDA.
Yes.
And Andrew has asked about their profitability.
Great questions. The influencer marketplace on the right-hand side was 2023. The day trading edtech business was second half of 2024. As it relates to profitability, on the right-hand side, the marketplace was barely profitable. We talk about profitability on a seller discretionary earnings basis, where we essentially remove non-carry forward costs. We add those back to the P&L, and we create therefore like an adjusted net profit line. And that's so as the buyer understands that on a carry forward basis, those one-time expenses are unlikely to be absorbed again. That would include things like if you paid for consultants to overhaul marketing, or you paid for a one-time design exercise that cost you a lot, or perhaps you had a management consultant come in. So those would be stripped out to give a better sense of profitability on a normalized basis. The day trading ed tech business, I must admit, I can't remember the net profit margin on that, but I'll certainly can follow up via email with that. Is the demand for US customer-based businesses higher than other countries? Absolutely. So short answer to that, if you have an American-centric business, you will tend to command a premium and therefore also appeal to a buying base out of the US, and therefore likely be dealing with American buyers, and they tend to be willing to pay a premium compared to other buyers around the world. All right, so moving right along, let's just talk for a minute about building a business with an exit in mind. Now, for some of you, this will be pretty rudimentary, but I think it's pretty important that we just tackle it briefly anyway. So understanding your business is really important. If you don't understand your business to the level that you should, buyers get gun shy. It is equivalent to pitching a VC. Buyers will expect the same level of detail in your understanding of how the business operates. It is still very much about storytelling, but unlike, say, raising seed, where it's about the opportunity, when you're talking to an acquirer, it's very much about financial best practices, understanding the performance of your business from top to bottom. And that obviously includes your revenue line, your cost of sales line, therefore your GP and the GP margin. It will include CapEx, albeit you're unlikely to have it in your domain, OpEx, and how your OpEx translates to business performance. And then ultimately, should you be profitable, understanding profit margin, or at least a pathway to. Now, the best way to achieve that is through clean and organized books. It is surprising how many good quality digital businesses and startups don't have clean and organized books. If you don't have a bookkeeper, get one. If you don't have an accountant, get one. If you don't use QuickBooks Online or Xero or the equivalent of those cloud accounting solutions, use them. That's really important. And it's the first thing, regardless of the opportunities available in your business, it's the first thing a potential acquirer will want to take a look at. The second thing as it relates to, and I assume that I'm talking to mostly SaaS founders, let me know if that's not the case, drop in various business models that you might be representing, and I'm happy to talk about them briefly. But it also assumes that you understand the value of your marketing and how that translates to winning a customer and retaining a customer. The number of times we see buyers of SaaS businesses ask about LTV to CAC and LTV to CAC ratio, and a misalignment or misunderstanding for how that's measured and calculated, or in some cases, a SaaS founder who just doesn't know, can limit your ability to have a constructive discussion with a potential acquirer. So get familiar with your business. Growth trends from top to bottom of funnel. So what is your demand generation? Is it growing? Is it declining? Is it flat? And what are your demand generation channels? What does the funnel look like? Top of funnel, middle of funnel, bottom of funnel? And ultimately, what percentage of your funnel do you collect at each stage of the user journey? These things are going to be really important, because what a buyer will want to understand is whether there's optimization opportunity for them, or whether you're actually running the business to its full possible potential already today. Operational excellence. Do you have comprehensive SOPs in place? Now, in this particular case, I imagine that I'm talking to most business founders and owners who are running businesses which are sub $10 million turnover. Again, a little bit different if you're operating at scale, but for those who are not, in most cases, your time with the business once the acquirer takes it over will probably be limited to 12 to 24 months post-acquisition, in which case they need to know how to operate this thing. And for this size of business, yes, there can be some strategics, and yes, there can be some institutionals. Yes, they are quite well resourced, but regardless, they need to put their money to work to ensure that they realize the opportunity in the business that they have acquired, and therefore comprehensive SOPs are critical. Do you have cross-trained staff that they can rely upon? And do you have very, very well documented vendor relationships? Finally, as you would expect, it's all good and well to have a great product. It's also good and well to say, oh, Horizon 2 and 3 of my product looks like this. It's also good to have a large TAM, but actually through an exit process, that's a little bit different to raising money. Sales solves everything. If you are not growing and you are not protecting the financial performance of your business through investment in sales and consistent ability to convert customers to revenue, that is scary for a potential acquirer, no matter what your opportunities look like in the future. So they want to see a growing customer base. They want to see declining churn. Actually, doesn't matter, we've found, what your churn rate is, so long as it's not catastrophic, but you need to have a pathway to declining the churn rate. And of course, evidence over time of better conversion rates from top to middle of funnel. Well, top to bottom of funnel, I should say. So moving right along, let's have a discussion about who will buy your business. And again, I'm going to assume that everyone on the call is sub 10 mil turnover. So let me know if I'm mistaken in there. And essentially here, sorry for the blatant itself for a minute, but we are benefited by seeing the data around what these buyers look for and who's who in the zoo. So we have 1.6 million global buyers. We have over $100 billion in buyer liquidity at any given time available to the marketplace. And this consists of side hustlers and acquisition entrepreneurs, but more probably pertinent to our discussion today, it includes strategics and institutional investors. So we've got private equity, we've got what you might call these days micro private equity, we've got family offices, and of course we've got strategics. Now there's just a couple of brand names on the right-hand side to give you some sense of the reach of our marketplace, but everyone from big media brands like Forbes to aggregators like Rainforest to big online publishers like Launch Potato to big sort of educational tech strategics like Rosetta Stone, owned by IXL, to big software aggregators like Constellation, which is likely familiar to most of you, to big private equity like Manhattan-based TZP Group. Now, it's a very big list. There's over 6,000 strategics and institutionals within the Flippa ecosystem that we'll match up to, but it's important to recognize that at your stage of business, should you be pursuing an exit, you can actually expect that high net worths and acquisition entrepreneurs are part of the mix, going head to head to drive competitive tension, which is a good thing, alongside strategics and more financial oriented investors. Cross-border is really interesting because great businesses are obviously created all over the world now. And that's awesome because that's respected. It's respected that a good Australian business can have a US and or global customer base and therefore can be just as appealing to a global acquirer as a local business might be in the location of that buyer. So the good news is that cross-border deals are more common than ever before, and you should capitalize on a global buyer base. Secondly, that there are lots of small deals done. The world of exits doesn't just revolve around unicorns and the media that you see in The Age, Smart Company, and the AFR. In fact, there's exits happening of all values all over the world. And you can see there that in the Flippa context, the average deal size is in the low 7 figures. Buyers own brands already, and they have a good sense for what is going to be a strategic fit for their portfolio. And that's what they're looking to establish and understand. We'll go through that in a minute. And of course, you should be working alongside a team of brokers or advisors who can help you get a deal done. We met an $11 million turnover Aussie business yesterday. And for the last 6 months, they've been trying to sell their business themselves. No broker, no assistance. And ultimately, they've just gone through a very, very exhaustive due diligence process. They're very tired. It's now fallen down at the last minute, and they've now come running to us for some help. So it is important that regardless of whether you use Flippa or anyone else for that matter, that you've actually got some assistance by your side. Okay, so let's just talk about the slight sort of differences between these types of buyer and give you a sense of the way they think about the acquisition process. So a strategic buyer is obviously the easiest to understand. They're going to be looking for synergies with their existing operations. So do you slot in to one of their existing strategic goals, or do you represent a Horizon 2 or Horizon 3 opportunity? Regardless, a lot of people will say, oh yeah, my potential acquirer is this brand. That's good. It's nice to have that view. And as you probably know, when you go to raise capital, sometimes there's that conversation about who's the potential acquirer for your business. The reality is there's very few strategic buyers for each business because you do have to have good quality alignment, and also you have to have good quality alignment at this particular time. So they're looking for synergies in existing operations, and the way to think about that is really to follow the news feeds for a lot of the brands that you think might be a potential acquirer for your business. So get a sense for what they're talking about strategically. They are often willing to pay a premium for the right fit. They'll pay overs. And this is why valuations are tricky for businesses, because a strategic is often not using a traditional valuation methodology. They'll be paying fair market value or fair market value plus overs. And of course, they are looking for market position. So it might be that your solution is a good fit for their strategic prerogative, but if it doesn't represent the right geography for that strategic prerogative, then it can be tricky. So there's lots of things that come into thinking about whether the position of your business is a good fit for that strategic acquirer. And of course, a good broker and or marketplace / platform like ourselves will obviously flesh that out with you. High net worths and family offices, really good buyers and coming into this space, this sub $10 million, sub $5 million space really fast. And we're seeing a lot of interest from high net worths and family offices. They're looking for subject matter expertise that they don't have already within their teams or the existing portfolio companies. They're obviously looking for bolt-on opportunities. So perhaps they own a chain of stores. Perhaps they need some kind of digital capabilities to now complement those stores. Perhaps your SaaS solution is that. So the bolt-on is really important to the family office type buyer. They value easy to operate businesses. Your job is to make your business sound simple to operate. The minute it's presented as complex, it's less likely that a family office buyer would be of interest. Stability is key. Don't try to sell a family office the idea that you haven't done a good job, but the opportunity is endless. That's less likely to appeal. What they're looking for is a good quality, resilient business, which has shown historical performance, which is predictable and repeatable. Private equity, obviously seeking specific return metrics. They tend to be financial buyers, therefore they tend to use traditional valuation methodology. They're obviously looking for scalable operations. And they typically, whilst they are coming down market, have very, very strict check size mandates. All right, so this is a pretty important slide. Many of you may for a capital raise process. Many of you may be doing that right now. It's actually a little, and this is a really important distinction between capital raising and the exit process. So in a lot of venture scenarios, particularly angel and seed, the investor is looking for, they're looking to understand you and your capability. They're looking to understand the idea, but they're less likely paying for historical performance. In some cases, it doesn't exist at all. In some cases, it's relatively limited. Whereas in an exit process, regardless of how good the opportunity looks long-term, they're actually paying for historical performance, even a strategic. That's the first thing on their mind. So this isn't venture. And you are probably, again, let me know if I'm mistaken, but you are probably not a unicorn. So key performance metrics are absolutely critical. Revenue growth rate, customer acquisition costs, customer lifetime value. You should obviously know the metrics that matter to your particular type of business within your industry. And of course, your business model, albeit I think I'm typically talking to a SaaS founder right now. So need to understand the key performance metrics, and they're the things you're going to have to present first. It's not going to stack up if you start talking about long-term opportunity, because that's for them to realize, given that you're highly likely to disappear within 12 to 24 months anyway. Not always the case, but most often the case. So they avoid, at this size, sub 10 mil turnover, they avoid customer concentration risk. At this size of business, it's just too risky for an acquisition to be limited to a small number of customers. They're likely to be a little fearful of huge amounts of founder or owner dependence. Again, different to venture. And then, of course, legal and compliance issues are quite a big no-no when you're looking to do a deal of this size, because it's just too costly for them to mitigate against and or lawyer their way out of a problem. The business isn't big enough to sustain that level of risk. So legal and compliance issues at this size of exit tend to be a bit of a no-no. Quite a high-level slide, but hopefully point has come across that they pay for performance. And of course, still, consider long-term opportunity, but that's not their first pass at an assessment. Seeing a few more questions.
There is one there from Bianca around customer concentration risk. What is it? Is it one type of customer, lack of diversity? So just clarification there.
Yeah, so a couple of examples we've seen here would be simply number of customers. So sometimes enterprise sales contracts are very big and they look really attractive. They're really attractive if you can find a new pathway to net new logos. So continue to acquire those customers. But if you've got an enterprise sales SaaS business and you've got 4 or 5 customers, that customer concentration risk is substantial. If you've got one type of customer, that's less of an issue, so long as you've got a large number of them. And the not diverse piece of it is probably more around the fact that you might have one contract type or one price point. And so diversity of customers by, micro business, medium-sized business, and enterprise-sized business would be helpful, albeit acknowledge that's difficult. As well as geographic diversity is often helpful. If you take something like a business that orientates around digital assets, for instance, or small, medium businesses, something that just orientates to e-commerce business owners, that can be considered a bit risky if you're tied to a single platform like Shopify or Amazon as a pathway to attach yourself. So those types of risks are certainly considered, but it is nuanced by business. All right, so valuing your business, valuation methodology. A lot of reporting on this. You see a lot of commentary about this on socials like LinkedIn. You can consume a lot of white papers around this on platforms like Medium. Highly encourage that reading, obviously. But in most cases, whilst there are formulas, buyers will ultimately decide based on how it fits into their business and what they deem the risk profile to be and how differentiated they see you against your comp set. So buyers decide fair market value, and that's a really, really important point. You then get to agree or disagree based on the number that those buyers will be willing to pay. But of course, there are very common valuation methods. So the SDE multiple, that's seller discretionary earnings. What this essentially means, as I alluded to very briefly, is that your P&L is adjusted for add backs. An add back is something that a small business owner is able to do when they can position past costs as non-carry forward costs. So these are one-time big expenses that you have had to absorb that it's unlikely that the strategic or financial buyer in the future will need to also absorb. It therefore can turn a SaaS business that is not declaring a profit into a profit-making enterprise, and it can give the buyer some sense of what the profit opportunity then looks like should they take out some of those investments in the business where you are investing mostly for growth, where the acquirer is less likely to do that in the future. A revenue multiple, typically very common around fast growth SaaS businesses or fast growth tech businesses in general. Revenue multiples can be benchmarked. There are lots of reports. We have them, as well as there are a lot of market reports from M&A advisors who will give you revenue multiple guidance for the industry and or the business model. There's asset-based valuation, where you essentially say, for instance, I've got a large community and I'm yet to capitalize on that community. I have an extraordinarily strong traffic base, and that's a moat for me. I have some IP. That IP is worth something. I have an AI algorithm which I can demo to you that works really well, and I have the data set which I'm valuing, but that hasn't been leveraged or recognized just yet into the business's revenue performance. And then there's a discounted cash flow model. Now, all of these things are important, but what we've found at Flippa is kind of the best pathway to valuation is an indicative valuation which takes into consideration market comps, so other businesses like yours. Takes into consideration industry-specific multiples, so that will be both business model and category. Takes into consideration recent sales data, so what has actually transpired in the marketplace on a half-on-half basis, and takes into consideration trend analysis, so how is your business tracking against the market. Now, often we will have public market multiples thrown at us. The challenge with a public market multiple is, of course, you tend to be dealing with a business operating at scale. You tend to be dealing with a market environment where there is infinite amount of liquidity, i.e., you can buy and sell the stock. And you tend to be dealing with a business which is clearly top 1 to top 10 percentile within its comp set. And that less tends to be the case in sub 10 mil turnover businesses. That might be what you aspire to be, but it's less likely where you're at. Then we often have thrown at us venture multiples. Well, venture is investing for the future. Remember, these buyers are buying on past performance whilst looking to leverage future opportunity. So it is a bit nuanced there. Okay, this is the scariest slide to present because founders get really scared. So this is not likely as high as you think, but exiting a business which is sub 10 mil turnover, there is a large buyer base. There is a lot of interest. It tends to be you can drive competitive tension as a function of the price points and how many buyers there are of interest to you for your particular type of business. But you can see here, for the sake of brevity, I've included 3 business types: an e-com business, an app, which is typically an iOS or Android app, or perhaps a Slack or Slack plugin, Chrome extension, those types of things. And then, of course, a traditional SaaS business. Now, of course, SaaS businesses come in all shapes and sizes, by industry, by average contract value, and lots of other factors. So it's clearly a generic reference to SaaS, but you've got multiples of revenue, not profit, showing you back to 2021 half 2. Now, there is a little bit of a gotcha in this data, in the sense that it's clearly only our data set. So it's Flippa's data set. So clearly there is other data sets that you can capitalize on and get some information from. And some halves we will sell a lot of SaaS businesses, and some halves we will sell fewer. But you can see back in 2022 half 1 that we were selling SaaS businesses on a multiple of revenue at nearly 6 times. And of course, the public markets for some high performance SaaS businesses, i.e. Shopify as an example, in some cases we're trading between 20 and 40 times. The market's changed quite a lot, but you can see that most recently, 2024 half 1, admittedly we haven't got the half 2 data here, you can see that the average multiple of revenue for a SaaS business was 3.6 times. So it has softened a little bit, but there's still good value, and it still is a great and viable path to a safe landing for a founder who's worked their butt off, tried really hard, and is now looking to find a pathway. All right. Looks like I'm keeping to time. Please let me know if that's not the case, Olivia. So we continue on here, and I'm going to just give you an example of a case study of a live deal to wrap up. And it will give you a sense of where a negotiation might start and where it might finish. And it's important not to get offended as a founder when a buyer makes their first pass. And so often you can go through multiple discussions finding agreeable terms. You can then have an LOI, and you can then have an executed LOI. You can then go through due diligence and get to an asset purchase or share purchase agreement. The terms will change throughout all of that as it relates to what the buyer ultimately ends up discovering. But it's important to sort of stay steady, be confident in the process, and not get offended, and just run it out in a pragmatic fashion. So this is an example. Again, I've deliberately used examples of some sub $10 million turnover businesses, hoping to be that that's the relevant audience for us here today. And so offer one for this particular asset came in at $4 million enterprise value on a $5 million ask. The terms are important to recognize. A lot of the times, those less familiar with the exit process think that 4 mil enterprise value is 4 mil cash. Not the case. 4 mil enterprise value in this particular case was best represented by 2.5 upfront and a $1.5 million earnout. And the performance measure was the trailing 12 EBITDA performance of the business. Okay. So what the buyer wanted to do was protect the asset's performance and hedge against downside risk. And they tied that to EBITDA. And instead of forecasting growth in the business, given the macroeconomic geopolitical environment that we are living in currently, where there's a little bit of uncertainty, the buyer was willing to tie that to the trailing 12 versus a forward-looking performance measure. The founders had to stay on for 12 months minimum, and there was a 120-day due diligence process. Now, that's very tiresome and burdensome for all involved. Where we ended up getting to, it says offer 2 there, it's really offer 3 or 4. There were multiple in between. But the ultimate outcome for this particular business was a slightly improved EV at 4.35 mil. That says 8.75% asking price. That's not the right reference there. It's 8.7%, 75% increase on the 4 mil EV from offer 1. You can see there the terms have slightly changed to 2.85 mil upfront. So the broker was able to get a little more out of the buyer to reward the founders upfront. And then there was, and again, that's stated incorrectly there, so apologies for that, but that's a 1.5 mil earnout. And the difference here is that the founder loses a little bit of control over the EBITDA business the minute that the assets change hands. Because in theory, whilst it's unlikely, you could have a buyer who throws a bunch of cost into your OPEX line and therefore impacts the EBITDA performance of the business. And so we wanted to tie this closer to revenue. And so in this particular case, the terms of the earnout, same quantum, 1.5, excuse the error there, was subject to the trailing 12 GP, so gross profit, which in this particular case was obviously revenue minus cost of sales. Founders' salaries were then added to the deal. So in addition to the earnout, the broker was able to negotiate on behalf of the founders very, very good fair market value salaries for each of the founders, so that they were heavily incentivized on a day-to-day basis in excess of the earnout opportunity. And we reduced the 120-day DD period down to 60-day and put a bit more pressure on the buyers to get the deal done. So ultimately, negotiation strategy is to know your walkaway price, have a view of what that is, structure deal terms obviously favorably, which can include multiple things, including upfront, including earnouts or different structures, as well as in this particular case, founder salaries tend to help ease the blow. Consider earnout potential and the way in which that's structured. And then, of course, plan for a transition period, because the number of founders we meet who say, look, I'd like to be out of this business in 3 months. I've really had it. That's less likely to fly. And so you want to plan for a transition period. Okay, that's it. I'm going to stop there because we've only got 9 minutes left, and no doubt there's a few questions. So hopefully that was helpful for everyone, and thanks again for your time.
Great session, Blake. Thank you very much. Heaps of really useful information in there. There are a couple of questions. Bianca has put a question in. What is a good or considered to be good EBITDA percentage of revenue for an e-commerce site? First one.
good question. Good as in high performance would be 15 to 20%.
Okay. Satisfied, Bianca? Can move on to Nick. Yep. How would the earnout typically be structured? All or nothing if you miss the target, tranches along the way, or something else?
Yeah. So in that particular deal, it is all or nothing, but it will tend to be structured. So you will tend to have something like 75% of performance, 85% of performance, 95% of performance, 100% of performance, and then overs. That will tend to be what you'll see. And so you'll see a table in the asset and or share purchase agreement, which basically governs that. The other thing is you can have what a lot of acquirers will more simply define as a stability payment. And it will simply say that if performance achieves X% of trailing 12, then the earnout is paid. So for example, 90% of the trailing 12 performance, if that was achieved, then the earnout would be paid.
Thanks, Blake. One from Remco. What proportion of your ultimate buyers are based in each of these regions, AU, EU, US?
So we have our dominant market is the US. Now, frankly, part of that is Flippa's strategy. So we're not suggesting that there's not a lot of opportunities all over the world and there's not buyers for everyone. There, of course, is. But Flippa's strategy is geared toward the US. So we have an oversupply of North American buyers. However, the good news is that across Europe and across Asia, including Australia, there is a fast-growing buyer network. And we are seeing more private equity become attuned to the idea of buying digital to complement their traditional industries and their traditional buying strategy. So plenty of buyers for everyone.
Thank you. James at Movable has told us he's got a million questions and it was a great presentation. He has got a question here. If you have an aspiration for a strategic exit in 3 to 5 years, how and when would you suggest trying to get a potential strategics radars?
It's a really good question. Kind of ask myself that. So part of what I would do is think about it as a funnel. So top of funnel is, who are all of the potential buyers for your business? Middle of funnel is what is the least path of resistance to get some kind of deal going? So can you do an event together? Can you forge a strategic partnership where there's a referral agreement in place? Can you build into their app ecosystem? Let's say, for argument's sake, you think that Xero, the cloud accounting software provider here in Australia, is a good potential exit target for you. Build to their app ecosystem, then attend their roadshows, attend XeroCon, which is the Xero conference. So start to build rapport and relationships with the executives that are going to be able to have an influence when that decision and ultimately when that opportunity arises for you. So a lot of it just comes down to being tactical and over a 3 to 5 year period of time, ensuring that you're in the right place at the right time. That's probably a bit of a cop out of an answer.
Right. To the point, as always, Matt Allen, what's the largest exit you've had on Flippa?
35 mil.
Woohoo. Good one. Ali, what's your advice to founders who are approached by a buyer, but they know it's the wrong time too early in the optimization process?
Yeah, it's interesting. Depends on how interested the buyer is and whether you can get the type of deal done that you think is going to reward you today and into the future. I mean, a bird in the hand right now is pretty good. And I would have that discussion and I'd take it to the end and then reserve the opportunity to say no. But I would not flat out reject someone who approaches you. I just think that there's too much at stake and you don't know where your business will be in 12, 24 or 3 years time. The number of times we've seen business owners say to us, look, this is fantastic, Flippa. We'd actually love to come back and work with you in 3 years time. 12 months passes and the business is actually in less good shape. So if your business is doing well now, that's a good time to contemplate an exit. Now, of course, if you're growing 200, 300, 400% year on year, that's a different story. And I totally respect that position.
Matter backs that. Get to term sheets fast. No need to take anything. The second liquidity window often doesn't open. Is this a question from Theme? We're considering a crowd fund and wonder how buyers view crowd-funded businesses, otherwise bootstrapped.
Yeah, they're fine so long as your cap table isn't crowded with hundreds of shareholders who you need to seek approval from. So long as you're giving away odds, or you're doing it by way of an SPV, or you're not even giving away equity, then it's looked upon favorably, because there's a large number of people who have solidified your idea and given you the money to keep going. So no issue there.
Great. One from Goose. How often? Can't see it. How often is it a 100% sale versus minority sale with a transfer of control?
In a Flippa world, it's mostly 100%. In a Flippa world. Now, we do see obviously deals done where it's 60, 70, 80, 90%. But typically it's a full transfer of control. It's either 100% asset sale or 100% share sale.
Great. Another great one from Bianca. Do you have a support service where you can help us get ready to sell, help us get our story right, or tell us what metrics we should show off? Or even can we discuss our current operations with you, and you tell us any areas that the buyer might not like or see risks in because it's hard?
Yeah, so we're all good and bad at some things. I'd say Flippa's less good at that piece of it currently. There are a couple of recent additions to our business which people should check out. We do now have Flippa University. There's 2 courses there, and it's free for founders, operators, and those looking to exit. So there is a seller boot camp. It's free. It's 4 hours in length. You can do it in your own time. You can check off the modules. And what you will essentially go through is the exit process from end to end, with a gentleman who sold his business for low 7 figures. He's also an experienced buyer on our platform, and he will take you through that end to end. It's free. It's well worth a look. The other thing is, and sorry for the blatant sell, Olivia, but we have the Exit podcast. And the Exit podcast is guests of lots of founders, not Flippa business owners, who have sold their businesses, and they tell their stories of how it came about and the process that they went through. There's over 200 episodes, 180,000 plus listeners per episode. It's very popular. Check it out. It's obviously free, and there's a new episode each week.
That's great. I'm copying those links. Thanks, Tori. We will add those to the recording in our Slack workspace. Make sure all the founders get it. That's a great plug, Blake. Unless there is maybe one final burning question, it is time. I know many of you will have to rush off to meetings. Otherwise, I will wrap it up. Thanks, Blake. Reshared your email address. Great session. It's one of the sessions where I can walk away and say, yep, we nailed that. Nailed the topic, nailed the presenter, and the indication of that is the amount of questions that come at the end of the presentation. I'm sure you'll hear from many here, Blake. Thank you for your time, your expertise in preparation and here right now today. Quick update on our next masterclass. TBC date likely to be the 26th of March at 12 p.m. It is on pricing strategies. It'll be another excellent masterclass. We'll get it into your diaries in the next week. Lots of thank yous going on in the chat. Once again, Blake, thanks. Everyone else, thanks for joining. Great to see so many familiar faces. A lot of tractors online. I think I won there, Alex. Anyway, that's it. We can all take off. I will share the recording. Have a great day. On your way.